Okay, so we will talk about the fair value gap. Okay, so fair value gap in the short form we can also call it as the FVG, which stands for the fair value gap. So basically what is a fair value gap means that it is an imbalance in the price. Okay, so it leaves a gap between the candles and it form a gap. So let me just throw the candles. So it is basically a three candle. Okay, it is three candle leaving a gap. So why are this fair value gap important is that this fair value gap are important because the liquidity was not fully traded. Okay, the liquidity was not fully traded here, and so the market often returns to this gap to grab the liquidity. Okay, so because of that the fair value gap is important, and the institution also often use these areas to enter the trades, and the market also came to this fair value gap to rebalance the price. Okay, so this is the fair value gap. Okay, so fair value gap. Okay, let me just give the wick of the candle. Okay, okay, so it can be here. Okay, and then okay here. Okay, let me just turn this into the black color. So okay, I think it's visible. Okay, okay, so this is the fair value gap. Okay, so here it has been break by the wick. Okay, if there is a gap like this. Okay, so this, okay, wait, okay, that's perfect. Okay, so if it break by this previous candle has been break by this wick, right, by the wick of the candle, so there is a gap between these three candle. Okay, so this is the fair value gap. Okay, if it has been break by the body, we have another term. Okay, we will discuss that later. So if it is break by the wick, we can call it as this as the fair value gap. Okay, so it doesn't matter if it has been break or did not break our previous candle. If there is a gap, then this will be called as the fair value gap. Okay, this will be called as the fair value gap. Okay, so the candle. Okay, let me also tell you that this candle. Okay, the candle here, if you look at the candle here, okay, this candle size, okay, and the color doesn't matter. Okay, and then even this candle size and color doesn't matter, but this middle candle should be the expansion candle, and then this should be in the bullish candle. Okay, bullish means it should be in the green candle for the bullish fair value gap. Okay, so this is the bullish fair value gap, meaning uptrend. Okay, so this should be the expansion candle, the bullish candle, which is in the green color. Okay, so you also have to remember that the 50% of the gap is the most critical point. Okay, so it also doesn't matter if this gap size is big or small. Okay, it doesn't matter. If there's a gap, that is a fair value gap. So if there's a fair value gap, that 50% of this gap, okay, this is the 50%. Okay, the 50% is the most critical point, okay, of the fair value gap. Okay, so let me also just give you an example of different type of scenarios that you can find the fair value gap. So this is one fair value gap. Okay, let me just give you another example. So you can find the fair value gap like this as well. Let me just change this one to the bullish candle. So here another candle here, so another candle here. So we have discussed that this candle size doesn't matter. Okay, this candle size doesn't matter. Okay, so we have the gap here between these three candle. We have the gap here. So this is the fair value gap. Okay, this is the fair value gap. Let me also just give the wick of the candle. Okay, to look more like a candle. Okay, so this candle size doesn't matter. Okay, so here the candle size is bigger, here the candle size is smaller, doesn't matter. Okay, so this candle color also doesn't matter. You'll find the fair value gap like this. Okay, and also you will find fair value gap like this. This is the bearish candle, and this is the bullish candle. This is the bullish candle, okay? And then this is again the bearish candle, okay? This is again the bearish candle. Okay, so let me just give you, okay, so this is break wick. This is the wick of the candle, okay? So in all these three situations, can you spot any difference? Yes, the difference is that this, okay, so this gap is smaller, this one is in the medium size, this one has a bigger gap, okay? So it doesn't matter, okay, the size of the gap, okay? So it doesn't matter the color of the candle here, the color of the candle here, the color of the candle, the size, the color, the size, the color, the size of the candle. It doesn't really matter here, okay? So it doesn't matter here. So these are all the fair value gap, okay? So this will be the expansion candle, which should be in the green color candle, which means in a bullish trend it should be the green color candle, okay? So this is the fair value gap, okay? So how you can take trade with the fair value gap, okay? So in order to take trade with the fair value gap, okay, let me just delete all this thing and I will show you. So in order to take the trade with the fair value gap, the candle must return to the gap and then it should have mitigated and then give rejection, okay? So meaning this is the gap here, okay? So this is the gap here, so the candle should come and mitigate this gap, okay? It should come and mitigate this gap, okay? This is, so now this gap has been mitigated by this red candle and it should have rejection. Rejection meaning like this, okay? Rejection. So here the gap, this is the fair value gap, the candle must return to this fair value gap and then it should get a rejection like this so that you can place your trade, okay? So it must have rejected so that you can place your trade, okay? So it doesn't matter how much the candle is in between, okay, but it must have been mitigated and then it should give rejection, okay? So this candle, okay, it did not mitigate, then you cannot look for the opportunity to take trade here, okay? So fair value gap means it must have been mitigated, so it doesn't matter how much the candle here is, okay, how much they can do here. So you have mitigated here, but then we don't have any rejection, okay? So you don't take trade on this on the next candle, okay? If there is rejection, like this, so this is the rejection, right? If you look at the wick here, it has got rejected from this gap, okay? So what you can do is that most of the time the next candle will be the bullish candle, okay? It will be the bullish candle. So fair value gap means you have to take trade only after it has mitigated the gap. Mitigated means touch the gap and then it got a rejection. After getting the rejection, you can place your trade to the upper direction here. First, sometimes, okay, I'll give you another scenario. Sometimes, okay, it come and mitigated, got rejection as well, okay? But this is the same color candle, okay? Meaning bullish fair value gap mitigated with the bullish candle, okay? It was mitigated, but it was a green candle. So in this case, the fair value gap, this gap has been mitigated, but however, the candle closes as a bullish candle here. This candle closes as a bullish candle here after the mitigation. So which also suggests that the next candle may retraces back, okay? Because if you look at here the market, if you look at here the price went up, it has mitigated and then it has directly went up, okay? It has quickly moved to the upper direction. So in this kind of situation, you can wait for the retracement, or it is advisable that you take trade with the sweat, okay? Okay, so but then we will discuss about that sweat in the later classes, but this is the point that you have to remember. Okay, so fair value gap means to take trade, you have to take trade after the mitigation and then after it got a rejection, so that you can take trade with this fair value gap. Okay, so this is just the basics. Okay, so similarly in the bearish fair value gap, bearish meaning in a downtrend. Okay, so bearish fair value gap is just the opposite of the bullish fair value gap. Okay, so it forms during a downward movement in the market, which means in a downtrend, so creating a price imbalance. Okay, so the market will often return to this gap to rebalance the price. So this is the bearish. Okay, so bearish. Okay, bearish fair value gap. This is the bearish fair value gap. So here, okay, so let me just give the candle like this. Okay, so it doesn't matter if there is wick or not, but let's just give some wick to look more like a candle. Okay, so here we have the gap here. Okay, so this is the gap here, this is the gap here. So this gap will be the bearish fair value gap. Okay, so like the bullish fair value gap, this 50% will be the most critical point. When the market come and got rejection from here, you can expect the next candle to went down here. Okay, so it also doesn't matter the color of the candle here, the color of the candle here, so the size also doesn't matter. Okay, but then the middle candle should be the bearish candle. Okay, so it doesn't matter if it is in the green color here, so it doesn't matter if this is a green color here. Okay, but then this should be the expansion candle, and then this should be in the bearish candle. So when the market come and mitigated this gap, got a rejection, then you can expect the market to went down on the next candle. Okay, on the next candle. Okay, so this is about the bearish fair value gap. Okay, so no matter how much the candle here is, but then it should have come and mitigated this gap and then got a rejection. Okay, so this is about the bearish fair value gap. It's just that opposite of the bullish fair value gap. Okay, so I hope you understand. And okay, so we will also talk about the inverse fair value gap. What is an inverse fair value gap? Oh, inverse fair value gap. Okay, so let's just delete this one and then I will give you another example. So inverse fair value gap means that the fair value gap that did not work fail. Okay, I hope you understand. And then it flips. Okay, and become the support or resistance. Let me just give you. So inverse fair value gap, we can also get a good inverse fair value gap, and I will also tell you what is a bad inverse fair value gap. Okay, so let me just give you the example. So this looks more like a candle, I think, with the wick. Okay, I think that's fine. So this is the fair value gap. So we have the fair value gap here, right? This is the fair value gap. We have the fair value gap. Okay, so the market is going in an uptrend. Okay, it is going up, but then for suppose this fair value gap did not work. Okay, and then got broken to the downside, then it could become an inverse fair value gap. Okay, it could got broken, then it could become an inverse fair value gap. Okay, so this fair value gap, this is the fair value gap, so this is the, okay, let's just make this one as the bearish candle. So this fair value gap did not work. Okay, the market did not respect this did not respect this bullish fair value gap, bullish fair value gap. Okay, and then the market just break this bullish fair value gap. Okay, so see, it did not give any rejection. Okay, it did not give any rejection, and then it has break out the fair value gap. So this will become an inverse fair value gap. Okay, so this will become an inverse fair value gap, meaning the market later, if come and got rejection, this area can act as the resistance, and then the market can move down from this inverse fair value gap. Okay, so but then this is not a good inverse fair value gap. In order to get a good inverse fair value gap, there must be another fair value gap created. Okay, So let's just see, this is the inverse fair value gap here. Let's just move down a little bit of this one, and let's just give some candle like this, okay, so that it looks more better. Okay, so here we also have another gap here, okay, another gap here. So this is the fair value gap here, another gap from in here. So here, this fair value gap did not respected the market break this fair value gap, and then also from another gap. Okay, so later if the market went up here, okay, the market went up here and then it got a rejection, the market went up to this gap, okay, and then it got a rejection from this inverse fair value gap, this from this inverse fair value gap. Okay, let me change the color. So this inverse fair value gap, and we also have the fair value gap here, okay, got a rejection, then you can place your trade to the downward direction here, okay, can place your trade to the downward direction. Okay, so this is a good inverse fair value gap, okay, this is a good inverse fair value gap. Okay, so let me just delete this one again. Here the market was moving down, the market was moving down here, okay, moving down. So this is the bearish fair value gap, right? So this is the bearish fair value gap. Okay, this is the bearish fair value gap now. But then this fair value gap did not respect, okay, the market did not respect this, the market did not respect this bearish fair value gap, and then it fit from a breakout, okay, so it fit from a breakout like this, then this has become our inverse fair value gap. So when the market later return to this gap, it can also act as the support, okay, it can also act as the support. But just along with the inverse fair value gap is not strong. That's why I told you that if there is another gap, okay, like this, if there is another gap here forming here, the fair value gap, another gap forming here, then later on if the market come and got rejection from this level, okay, if the market come and got rejection from this inverse fair value gap, and then the fair value gap got rejection, then you can anticipate that the next candle will went up here, okay. So okay, so this is about the inverse fair value gap. Okay, so I hope you understand what is which one is a good inverse fair value gap and which one is not a good, which is a bad inverse fair value gap. Okay, so inverse fair value gap means a fair value gap that flips, okay, and act as the support or resistance. Okay, okay, so this is about the inverse fair value gap. I hope you understand what is an inverse fair value gap. So we will talk about what is the breakaway gap. Okay, so breakaway gap, there is not much of difference about the breakaway gap and the fair value gap, but there is still some difference. So we will talk about what is the breakaway gap. This is the gap. Okay, so this is the gap, we have the gap here. Okay, so we will call this as the breakaway gap. Okay, so okay, so what is the difference between the breakaway gap and then the fair value gap here? Okay, so the difference is that for the fair value gap, it has, this is the wick, right, it has break with the wick, so that we call it as the fair value gap. But the breakaway gap means it has break with the body of the candle. Okay, this body candle has break our previous candle, so we call this as the breakaway gap. Okay, that's the only difference. Okay, so that's the difference between the breakaway gap and the fair value gap. Break by wick is the fair value gap, break by body is the breakaway gap. Okay, so when the breakaway gap occurs, the market continue moving in its same direction, okay, even without retracement. Okay, even without retracement. So let me just give you the example here so that you better understand. Let me just, okay, so here it has break by the body. Okay, break by the body, right? See, our previous candle, this candle has break by the body. If it is like this, then this will be the fair value gap, right? But it break by body, so this is the breakaway gap. Okay, so when this breakaway gap occurs, you can take direct trade. Okay, you can take direct trade here without the. You can also take direct trade here to the upper direction. So we are talking about the bullish breakaway gap now without the retracement. Okay, without the retracement, you can also take direct trade, but in some cases the next candle may also retraces back. Okay, in some cases the next candle may retraces back and from as the bearish candle. So even though it did not mitigate it, okay, so it has retraces. Okay, it did not mitigate the gap. Okay, it did not mitigate the gap, but then you can look for trade to the upper direction considering the availability of the room. Okay, so you should consider if there is room available for the next candle to move. Okay, so if there's room available, you can take direct trade from this gap. Okay, okay, you can take direct trade like this. Okay, even without mitigating. Okay, for suppose if there if there is the target, this is the recent target. Okay, we will talk about the target, but this is the recent target. Okay, so the market has already mitigated this recent target. Okay, it has already reached this recent target. Then even though we have the breakaway gap, we need mitigation of this gap. Okay, so we need mitigation here if it reach the target. If it reach the target, okay, we need mitigation. So after mitigation, if you get a rejection like the fair value gap, then you can expect that the next candle will went up. Okay, so this is how you take break with the breakaway gap. Okay, so this is the difference between the breakaway gap and the fair value gap. Okay, so I will also tell you more, okay, about the breakaway gap. Wait, so if there is two continuous breakaway gap, okay, so for suppose let's just delete this one for now. Okay, so there is another breakaway gap here again. Okay, there's another breakaway gap, so we have continuously two breakaway gap here, right? Two continuous breakaway gap here. Okay, this is the breakaway gap. Okay, so it has break with the body, right? See, it has break with the body of the candle, so we have two continuous breakaway gap. Okay, so in this case, this suggests that also indicates that this is a strong momentum. Okay, and of the continuation of the market. But however, if these two type of two breakaway gap produced in the market, then there can be still one or two retracement. Okay, if there is two continuous breakaway gap. So for this reason, it is generally better to wait for the retracement of the candle. Okay, regardless of whether it is mitigated or not. Okay, so if it did mitigate or did not mitigate, you have to wait for the retracement. Retracement means the bearish candle retracing back. Okay, so if it is mitigated, it's better. If it is mitigated, got a rejection, you can place your trade to the upper direction on the next candle. And also if it did not mitigate it also, you can look for the trade to the upper direction. Okay, but if there is two continuous breakaway gap, then you have to wait for this one or two retracement, because there can be retracement in the market if there is two continuous breakaway gap. Okay, if there's two continuous breakaway gap. Okay, so this is about the breakaway gap. So similarly, it's same in downtrend. It's just the opposite of the bullish breakaway gap. It has to break by the body. That's it. So bearish breakaway gap will look something like this. There's a gap. Okay, this is the candle. These are the candle, and this is the candle. Okay, so it has break by the body of the candle. Okay, so it is formed by three candles. So we have the gap here. So this is the breakaway gap because it has break with the body. So it's just that opposite of the bullish breakaway gap. So you can expect your trade to went down directly even without mitigation. Okay, even without mitigation. So if it reached the target, you have to wait for the mitigation. Okay, and also you have to look for the availability of space in order to take break. Okay, so this is about the breakaway gap. Okay, so we will talk about another gap, which is the opposite candle fair value gap or the color change fair value gap. Okay, so it's kind of, it is just similar to the breakout gap. You can take direct break with the color change fair value gap. Okay, which means that, so we will first discuss about the bullish color change fair value gap. Color change meaning the color has been changed. Okay, the color has been changed. Okay, so this is the candle right here. Okay, so let me just give this one in the red color. Okay, so I will just give the wick here, so that, okay, so this is the candle here, and then we have the candle here, we have the candle here, and then it has break by the body or the wick, doesn't matter here. Okay, so it has break the previous candle with the body candle, or if it just break with the wick of the candle, it doesn't matter. Okay, but then the last candle, this candle should be in a red color. Okay, so that we can call this as the color change fair value gap. So this is the two green candle, one red candle, for example. So this is meaning the color has changed, right? So this is the color change fair value gap. So this will be the color change fair value gap. Okay, so when this color change, okay, so the color change also, this candle color doesn't matter, it can be in a red color. But then this, for the bullish color change fair value gap, this candle should be the expansion candle like the fair value gap, and this should be in a green candle, and then this last candle should be in a red color. Okay, so this is called as the color change fair value gap, or you can also call it as the opposite candle fair value gap. Okay, okay, so here, if there is the color change fair value gap, you can also expect the market to went up directly here, even without mitigating the gap. Okay, even without mitigating the gap. But then also, it is also important that you have to check that if there is enough space available or not. Okay, so if there is no room available, say for example, we have the target over here, this is the target, we will talk about the target of the market. But if it has reached the target like this, okay, so then it has reached the target here, then you need to wait for the mitigation. Okay, you need to wait for the mitigation of this gap, and then got a rejection like the fair value gap, got a rejection here, so that you can look, okay, wait, so that you can look for the trade on the next candle. Okay, you can also look trade on the next candle. So doesn't matter if it mitigate or not. Okay, if there is still room available, then you can directly take trade with the color change fair value gap. Okay, so in the bearish scenario, let me just give you an example. In the bearish scenario, it will be like this one. This will be in a, okay, so let me just give you an example. So this will be the gap here. So we have the gap here, so this is the color change fair value gap. So let's make this one into the bearish candle. This should be in the bearish candle, the middle color. So here we have two bearish candle, one green candle, so the color has changed. So you can take direct break here, or even after mitigation of this gap, you can take break here. Okay, so this is the color change fair value gap. So we also have to look at about the importance of the third candle rule. Okay, the importance of the third candle rule. So let me just grow the candle, and then I will just explain. So here we have the gap. Okay, for suppose we have the gap here, okay, this is the gap. This is the candle. Okay, so this is the breakaway gap, this is the breakaway gap. Okay, and then we also have the bearish breakaway gap. This is the bearish candle, and this is the bearish candle. Okay, so we have the bearish breakaway gap here. Okay, breakaway gap. Okay, so let us just discuss. Okay, So the third candle rule, meaning if this third candle, okay, it is an unusual candle, like this the long candle, okay, and it is unusual like this, a long candle like this, unusual, then even though if it is a breakaway gap, you have to wait for the mitigation of the gap, okay. So we have discussed that if there is a breakaway gap, you can take direct trade. But if this type of unusual candle happens, okay, long candle unusual happens, then you have to wait for the mitigation. You have to wait for the mitigation of this candle or of this gap, and then got a rejection, from this gap, so that you can look for the trade on the next candle, okay. You can look for the trade on the next candle, okay, if there is unusual candle on this third candle, okay. So also if there is also like the candle like this upper wick rejection, okay, upper wick rejection like this, upper wick rejection, okay, upper wick rejection like this type of candle, okay, have a long upper wick rejection, then even though this is the breakaway gap, then you have to wait for the mitigation, okay. You have to wait for the mitigation of the gap. You have to wait for the mitigation of the gap. Got a rejection from this gap, and then you can place your trade on the next candle to the upper direction, okay. If this candle, third candle, has a long upper wick, okay, it can be like this, or it can be like this, okay, long upper wick, okay. And also if it from as a doji type, okay, doji candle like this, okay. So this third candle, okay, this is very important. If it from like this, then you have to wait for the mitigation of the gap, got the rejection, and then you have to place your trade, okay, so what will be the good candle? So this normal candle, okay, normal candle are good candle, you can place your trade directly. Or if there is the, okay, so like this, okay, the lower wick rejection, this is fine, this is also a good candle, you can place your trade directly to the upper direction by looking at the availability of the room, okay. But if there is also like too much space, okay, too much space like this, okay, here if you look at here, this too, the wick is too long, so there's too much space available here, so the candle may retraces, okay. So you have to wait for the mitigation, okay, mitigation or retracement, okay. You cannot take trade directly, okay, if there's this type of long lower wick, okay. So this is about the third candle rule. So it will be similarly in a bearish gap, okay. This is the gap. So if this third candle is an unusual candle like this very long, then even though this is the breakaway gap, you have to wait for the mitigation of this gap, got a rejection, and then you place your trade, okay. And then also if the candle has like the along with rejection like this, and this third candle as a wick like this, then you have to wait for the mitigation, and then you have to take trade, okay. And then also if this third candle, is also a doji candle like this, so this is, if this is a doji candle, then you have to wait for the mitigation of this gap, and then you have to also wait for mitigation, and then you have to take trade, okay. So the good candle will be like this, a normal candle, this is a good candle, you can expect the third trade. But if there is also like this too much space available like this candle, and then you have this is, even though this is a good candle, if there is too much space here, okay, the next candle may also retraces back, okay. So you have to look out for that as well. So this is about the breakaway gap, about the third candle rule. Okay, so we will talk about what are manipulation gap. Okay, so manipulation gap are those gap which have the low probability of working. Okay, so when the market reaches its target, either it be the external or the internal target. The first gap will considered as the manipulation gap, and also, if the gap has already been mitigated before and the market reverses to the gap again, that could also be the manipulation gap. Okay, so I have just placed the ground the gap here, and then I will show you what are manipulation gap. Okay, so this concept we'll discuss more in detail in the following classes. Okay, so this is just the basics of that you need to understand. Okay, so you have to keep note of this point that we are going to discuss, so that in the later classes you will understand better what are manipulation gap. Okay, so I'll tell you. So these are the manipulation gap. So here, if you look at here, so this gap has been already, we have the gap here, right? We have the gap here. Okay, so if you look at here, we have the, this is the gap right here. So we have the gap here. So this fair value gap has been mitigated. This fair value gap has already been mitigated. The market went up, and then it came down again. Okay, so even if the price breaks from this gap again, okay, this breaks again, you cannot take break on this gap, because this gap has already been mitigated, and the gap should be used only one time. Okay, so after the mitigation, if you look at here, after the mitigation also, we still have some gap below. Okay, so here this is mitigated, and then we have the gap below. So these are the manipulation gap. Okay, so this gap will be the manipulation gap, and then even if the candle give rejection from this gap, you cannot place your trade to the upper direction or neither to the downward direction. So the bearish in a downtrend, it will be the opposite of this one. Okay, so this is the manipulation gap, and then also this is the target. Okay, for suppose the market target has been reached. Okay, the market was moving like this, target was reached the target. Okay, so after reaching the target, this first gap, okay, we have multiple gaps here. First gap, we also have the gap here, but after reaching the target, the first gap, this first gap will be the, this first gap will be the manipulation gap. Okay, this first gap will be the manipulation gap, so you cannot take break here. Okay, so even if the candle come here and then got rejection from here, then you cannot take break to the upper direction here. Okay, because these are manipulation gap. Okay, you cannot take break here. So we will discuss more about this concept in the later classes about the manipulation. Okay, so even here, if the market reach the, so we have discussed that this can be the internal target or the external target. Okay, we will discuss about the target in the later classes, but this can be the external or the internal. If it reaches the target, the first gap will be the manipulation gap. Just keep note of that. And then also, if the market reach the external, now this is the external. Okay, this is the external target. So if the market reach the external target, then the first gap on the left, this first gap, and then this first gap on the right, this first gap on the right, this both are manipulation. Okay, this both are manipulation gap, this both are manipulation gap. So even if there is candle rejection from this gap, you cannot take trade. Even from this gap, if there is candle rejection, you cannot take trade. Okay, because these are manipulation gap, and you cannot take break on this manipulation gap. Okay, so we will discuss more about this manipulation concept in the later classes. So this is just the basics of manipulation gap that you have to understand and keep in mind. Okay, so this will be it. So the bearish manipulation gap will be just be the opposite of this bullish manipulation gap.